The Fed isn't fighting inflation. It's a convenient story. Your mortgage, your car loan, your job security, they're all caught in the crossfire of a completely different war. Here's what's really happening. The Fed is using rate hikes to deliberately cool the job market, and a single speech from Governor Christopher Waller is the signal. But the real target isn't the price of gas, it's the price of your paycheck. The markets are now placing their bets based on this hidden agenda. This week, all eyes are on the financial world's biggest drama. Traders are piling up bets on another Fed rate hike. The media tells you it's because of upcoming inflation data. They point to Fed Governor Waller, a known hawk, who is scheduled to speak. The surface story is simple. If inflation is hot, the Fed hikes rates to cool it down. Higher rates mean your credit card debt, car loans, and mortgage payments go up. It's presented as a simple cause and effect, a necessary medicine to cure the economy. But here's the question they never ask. If recent inflation numbers have been cooling, why is the threat of a rate hike suddenly back on the table? The answer is that we've been looking at the wrong numbers. The truth is, the Fed isn't really looking at the headline inflation number, the one you see on the news. That number includes volatile things like food and gas. The Fed's real focus is on something they call core inflation, and even deeper, they obsess over supercore inflation, which is the cost of services minus housing. What does that actually mean? It means your haircut, your insurance premium, your restaurant meal. And what is the single biggest input cost for all of those services? Labor, wages, your paycheck. When a Fed governor like Waller warns that rate hikes are on the table if core inflation stays hot, he is sending a coded message to Wall Street. He is saying, we are not satisfied with the current strength of the labor market. Wages are still rising too fast for our liking, and we are willing to raise interest rates and risk a recession to slow it down. This isn't a theory, it's the playbook. Higher interest rates make it more expensive for businesses to borrow, expand, and hire. It pressures them to cut costs, and the easiest cost to cut is payroll. The bets mounting in the market aren't just about an inflation number. They're bets that the Fed will successfully make your job less secure. So what does this coded war on wages mean for you? First, forget about significant relief on your borrowing costs. As long as the Fed maintains this posture, even the threat of a hike keeps rates on mortgages, credit cards, and car loans elevated. Banks aren't going to offer you a cheap 30-year mortgage when the Fed is threatening to make money more expensive. Second, it creates a split economy. Large corporations sitting on piles of cash can weather high interest rates. They might even benefit by buying up struggling smaller competitors who rely on credit to operate. This is a mechanism for market consolidation, a transfer of wealth from Main Street to Wall Street disguised as monetary policy. Most importantly, it reframes your job security. In this system, a strong job market with rising wages isn't a sign of a healthy economy. It's an inflationary problem for the Fed to solve. Your bargaining power, your ability to ask for a raise, is a direct threat to their goal. They are not trying to fine-tune the economy. They are using a blunt instrument to slow the one part of the economy that benefits workers most directly, a tight labor market. Is the Fed's war on inflation really just a war on wages? Let me know your thoughts in the comments. You came here wondering about rate hike bets. Now you see the real target isn't just a number on a screen, it's the labor market. The public story is inflation, but the coded message from officials like Waller is about slowing wage growth, even at the cost of your job. If this was eye-opening, subscribe to Decoded Money and hit the bell. In our next video, we'll reveal how the government's own debt is the one inflationary force the Fed can't control. Now you see how the money really moves. Money, decoded.